Hello and welcome to the CNBC-TV18 Mumbai newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh. You're watching Mutual Fund Corner. Well, today's show is going to be all about our viewer queries. We get a lot of them over time, right? So we thought it's a good time to get all of them together and get in our expert, who is Mr. Gaurav Gupta, Director at G-Cube Investments, to answer all your mutual fund queries for the day today. Gaurav, thank you so much for joining us here on CNBC TV18 to answer a whole host of queries that we've received from all our viewers as well. So let's get started with that, and we'll speak about the first query that we have received today. Shashank Bhatia is writing to us from New Delhi. He says he wants to create a portfolio of 4 to 5 mutual funds via an SIP route. He wants to know 2 schemes with a long-term horizon of over 10 years and another 2 with a 2-year view for a medium risk profile. Well, Gaurav, Shashank wants a very balanced portfolio, 4 to 5 mutual funds here. What do you suggest? Is that amount good in terms of number of mutual funds? And he wants both a long-term perspective and medium risk perspective as well. What are your thoughts here?
Yeah, good afternoon. Given my perspective, I would say that, based on a 10-year view, he should, consider investing in mid and small cap funds, because what's happened is that mid and small cap funds usually give alpha of maybe 5 to 7% over a large cap or a multi cap over a 10-year time frame. We can see from historic returns that large cap funds have given about 15%. Compared to, say, a mid cap or a small cap, which has given about 20 to 25% on a 10-year basis. So if his investment horizon is 10-year, he should definitely consider investing in a mid cap fund, like a Kotak Emerging Equity Fund or a SBI Magnum mid cap fund in the mid cap space, as well as in the small cap space, he can look at a Nippon small cap fund. With regards to his 2-year SIP, usually SIPs are not considered for a 2-year time frame. Maybe a debt SIP can be considered, because he must be having some short-term goal that is in mind from a 2-year time frame. So then he could look at something like a target maturity fund which invests in government securities. Or he can even now consider a bank FD with the change in tax implications that were done towards the end of March.
Okay, got that. And, like you were mentioning, the fact that he does have a 10-year horizon for at least some of his funds, that also minimizes the risk that you would perhaps see usually in a mid-cap, flexi-cap kind of fund, right? So it's definitely beneficial to have that long-term horizon. Gaurav, thanks for joining us. This is Pavitra. The next query that we have comes in from Tushar, who's written in from Pune. He says that experts like Ray Dalio have mentioned that in these inflationary days, one should perhaps not invest in instruments with debt as a denominator. He's asking if these comments signal against investing in debt mutual funds. I think the main crux of the question is that, if you do want to invest in debt, where do you invest? And do you just stay away from the entire debt space at a time like this? Interest rates is one, but there have also been so many changes on the tax front. What would you suggest if someone does want to take some amount of exposure to debt? What do you do?
With regards to now debt, what I'm feeling that he's talking about, US debt, because Ray Dalio is, giving his comments on, US debt, and, US has $31 trillion of, debt. And similarly, the Fed has also raised rates 9 consecutive times to close to 5% currently. As far as Indian debt market is concerned, we can see that, these funds like these target maturity funds, which are investing in government securities, which is your sovereign debt. I don't think there is any risk of default, because it's like saying that the government of India will, default on any sort of, instrument or paper. With regards to, the debt taxation, per se, then, he can do a mix of maybe a fixed deposit as well as a target maturity fund, because of the change in the taxation that has happened at the end of March. The taxation on a fixed deposit or a debt fund would be treated equally.
Okay, we get that. That's very helpful in terms of what advice one should cater to, at least when investing in debt funds, has seen so many changes in just last couple of months. So definitely an expert advice is something which is very helpful here. Move on to the next query now. Satya Balakrishnan writes to us from Bengaluru, wants to invest for 15 to 20 years through an SIP route and can invest up to 5,000 a month. She wants to know funds where she can invest in. Gaurav, your take, 15 to 20 years is the time horizon here, wants to start an SIP. What do you suggest in this case?
Again, with like a 15 to 20-year horizon, then again, my picks would be, the mid and small cap category again, because, like I mentioned earlier, that over a period of time, the mid and small cap has delivered a significant alpha. Even like the Nippon Small Cap Fund or the SBI Small Cap Fund, they have given a 10-year CAGR of close to 25%, which there's no other fund which is coming, close to that category. Similarly, in the mid-cap space, we have here that Kotak Emerging Equity Fund, which is also given a close to a 20% CAGR. And just to, throw in some numbers, a 5,000 rupee SIP at 12% over a period of 20 years would grow to around, you can say 50 lakh rupees. Compared to that, if you are looking at a 5,000 rupee SIP at 17% per annum, which is a 5% more per annum, that is growing to a corpus of 1 crore rupees. So, that extra 5% per annum alpha over a period of 20 years translates to almost, translates to double amount of corpus over a period of 20 years. So, though even if he's a medium risk appetite, then he can maybe look like a multi-cap or a flexi-cap fund. But I would suggest more to go for a small cap or a mid-cap fund.
Okay, you can definitely play around in the small and mid-cap if you do have such a large time horizon and take advantage of that. Helpful advice there. The next query comes in from Vishal Kumar, who's written in from New Delhi. He is asking about, considering the fact that we're seeing this volatility in the market, he asks if he should maybe shift his portfolio to include some amount of flexi-cap mutual funds as well. Gaurav, you think this is a good option?
What is his current portfolio? Is he having large cap? Because in the question is not mentioned that whether he's having large cap or small cap or mid cap.
I know that was a question I had as well. So we don't actually know his current portfolio. So maybe you could just suggest some flexi-cap funds which you think are perhaps good to get into. And when do you think an investor should look at a flexi-cap fund? Who is it correct for? That would, I'm sure, help our viewer as well.
My top pick would be the Parag Parikh Flexi-cap Fund. That's been, it's going to complete, in fact, 10 years on the 25th May 2023. It's almost having a 18% CAGR return for the last 10 years. It's giving also overseas exposure of about 10 to 15% through, investments in Alphabet, Microsoft, and they are having small exposure in Facebook as well, but which is your Meta. But overall, that fund has, delivered returns across all time frames. And even HDFC Flexi-cap can be considered, even with, Prashant Jain leaving. Ms. Roshni Jain is managing the fund, and it seems to have, given a consistent return over a period of time.
Okay, all right. So those are the two picks as far as flexi-cap category is concerned. And this is something we need to discuss also, Pavitra, right? Yeah. This is a category which has been getting a lot of interest. So whether that works, what doesn't work, we'll discuss that in greater detail in some other show. But for now, we'll slip into a short break. And on the other side, we'll continue our discussion with Gaurav Gupta of G-Cube Investments and get all your mutual fund related queries. Stay tuned for that.
Welcome back. You're still tuned into MF Corner here on CNBC-TV18, and we still have Gaurav Gupta of G-Cube Investments to answer all of your queries. We're addressing a lot of individual queries that have come through to us on our portal, so we're going to really address them. Gaurav, the next query is from Mayank Gupta. He writes in from Indore, and he says he wants to know if it is a good bet to invest in small cap funds compared to other categories and, looking at the volatility in the market. I know in some part you've already answered this, but take us through a good small cap fund that you could invest in right now.
Yeah, so my top pick would be the Nippon Small Cap Fund. The reason why I'm suggesting this fund also is that it's got maybe a 13, 14-year track record now. The 10-year CAGR of the fund is around 25%. Secondly, the fund is having a portfolio of around 120 to 130 stocks. This you usually do not see in a small cap fund because the fund AUM is close to 25,000 crores now. So what they've done is that they haven't kept more than 1.5-2% exposure to any single stock. So usually what happens in a small cap fund, if you're having a larger weightage to a single stock, then there could be a liquidity issue due to in case the company is not doing well and the fund manager wants to sell the stock in the portfolio. So with the 120 stock portfolio and Mr. Samir Raj has been managing this fund for the last 6-7 years, and I think he's done an excellent job. And Nippon as a mutual fund has now in the last couple of years, again, the equity funds, most of them are on the top quartile. So definitely Nippon small cap fund would be, the fund I would be recommending for him.
Okay, we get that point. Nippon India Small Cap Fund is your take here or your preference as far as small cap investing is concerned. Let's move on to the next query. Rohit Jain writes to us from New Delhi. He wants to start a children's education fund for his 5-year-old. He wants to know if he should look at via SIP or is it even too early to think about your child education plans. I think I would assume that it's a great start that Rohit is making. Gaurav, what would your suggestion be? How should he go about planning his child's future and especially education plans here?
I would say it's great that he's looking at starting, so early, since his child was 5 years old. And the earlier you start a SIP, obviously the better it is. And, he can benefit from, the compounding effect if he holds it for that 15, 20-year period. And also what we are seeing is that the cost of, education is increasing every year due to, inflation. So, investing in SIPs would help him, fight inflation and help him to, develop a substantial corpus for his child, maybe when he turns maybe 18 or 20. And maybe depending on the amount he's looking at investing, if he's, looking at private education or for sending his son abroad, he can, consider investment. Depending on his risk profile and, I'm not sure exactly, what his risk appetite is, but, taking a medium sort of risk in mind, I would suggest that he can go in for a large cap, a flexi cap, a mid cap and a small cap. Broadly, these 4 categories are the, funds that, the SIP can be divided into. On the large cap side, it would be the SBI Blue Chip Fund. On the flexi cap, like he can select a HDFC flexi cap. And in the mid cap, the Kotak Emerging, and in the small cap, like I said earlier, the Nippon India Small Cap.
Okay, that is very useful. And, like you mentioned as well, never too early to start with your investments. So if he's considering looking at this when his child is just 5 years old, it's even better perhaps than, waiting a couple of years. The next query comes in from Shweta Srivastava. She writes in from Chandigarh and she says she can invest around 10,000 rupees every month for the long term or, even for at least 20 years she's looking at. So she's looking at 10,000 rupees per month for a 20-year period. She says that she's a medium to high risk kind of investor. She's willing to take on some amount of risk and she wants to know what is the kind of corpus that she can generate if she does put in 10,000 rupees per month, and also what schemes she should look at. I think you've taken us through some schemes that would be good from a longer term perspective, but she's asking what is the corpus she can look at if she puts in 10,000 rupees per month for a 20-year period.
So the 10,000 rupee per month at 17% per annum for 20 years would generate around a 2 crore rupee corpus. And similarly, that same 10,000 at a 12% per annum for 20 years would generate a 1 crore rupee corpus. So that's why I said that, if the time horizon is longer, definitely the allocation to, the mid and small cap can be maybe out of that 10,000 rupees, around 6,000 rupees, 3,000, say in a mid cap and a small cap fund, and the balance to 2,000 rupees can be put maybe into a flexi cap and a multi cap sort of fund.
Okay, all right. So that's the kind of split Shweta should look at with the corpus that she has and what she is willing to invest as well. Let's get to our next query now. Kusum Lata is writing to us from Mumbai. She says she's been reading about the opportunity in dividend yield funds. SBI also recently launched their fund. She asked if it is a good space to be in, considering that PSU stocks have been rallying. In that case, Gaurav, what would your sense be? Because dividend yields would be higher if the stocks are on the lower side, but these stocks have been doing well so far. What's your sense at current levels and current valuations and dividend payouts as well?
Dividend yield is always, I would say, a good allocation. It should be 5 to 10% of your overall portfolio. Say if you're investing 100 rupees and 30% exposure you're giving to a large cap fund, you can consider out of the large cap portion to put about 5 to 10% of the portfolio of your large cap allocation into this dividend yield category, because most of the dividend yield funds, most of the dividend yield stocks are large cap oriented stocks. So even though, like you rightly said, there has been, a PSU rally that has happened, and a lot of companies have declared, high dividends. But going forward, I think this category can be, more for risk-averse investors, because what happens when usually markets fall, these dividend yield funds or dividend yield stocks, they fall less than the market. The beta is much less than the market fall.
Okay, so that is on dividend yield funds. This space has also been garnering a lot of attention. Like Sonal was mentioning, the dividend yield fund by SBI also just came out and it managed to see a lot of inflows during its NFO as well. So it's definitely a space that has become a little bit more popular. But the next query comes in from Jaspal Singh, who's written in from Amritsar. He says that he's looking at some amount of debt exposure, and he asks which schemes he should pick and the categories as well, because within that debt there are so many different categories you could look at. He's once again looking at a long time horizon. 10 years is what he's looking at. So Gaurav, with the 10-year time frame, you want to give us 2 or 3 debt funds that would be a good pick?
Yeah, again, there is a Bharat bond ETF, so which is by Edelweiss, the Bharat bond. So they are investing in 10-year PSU bonds. So that has a April 2033 maturity. Similarly, there are target maturity funds, which are basically index debt funds. So you have like a HDFC index debt fund, which of September 32 maturity. Similarly, a Nippon target Nifty GSEC fund that's having a 2036. So these are all between the 10 to 13-year bracket, where he can look at investing. He can also consider investing now some money into fixed deposits with this tax implication change that has happened towards the end of March. So, he can divide it between maybe these Bharat bond and these target maturity funds, and some money towards fixed deposits as well.
Okay, all right. So this is about Jaspal's query, what he can do with the funds he has and the investment plans that he has as well. Shruti Arora is writing to us from Bihar. She asks, following the recent debt tax amendments, what is the best inflation beating tool available now which can also take care of long-term goals such as retirement? Gaurav, your take here?
See, now what has happened with the recent tax implications, even a fixed deposit is yielding 8%, or a target maturity fund is giving between 7 to 8%. Now with a 30% tax bracket, your net tax return is coming to around 5.5%. In today's inflationary scenario, the inflation is bare minimum around 6 to 7%. So I would say that it's not covering, the debt is not covering the cost of inflation. So he would have to look at some equity exposure, with this, change in tax that has happened. And the way to do that would be either to invest through equity mutual funds if he's having a 7 to 10-year horizon, or if he's a little bit moderate risk investor and having a slightly shorter horizon, he can look at the balance advantage funds, which invest about 30 to 65% in equity and the balance in debt.
All right, we got that, and that is some good advice on how you should, try and get some amount of debt exposure. Gaurav, we're going to wind down on that note, but thank you as always, for taking us through all of our queries and helping our individual viewers to sort of really address what their concerns are. But thanks a lot for that. On that note, we're going to wind down on this edition of MF Corner. You stay tuned because closing bell comes up after this very short break to take you through the final hour of trade.